Hi, I'm Brock.
I'm Jim.
Before we get started, if you want to stay ahead of the cattle markets, sign up for our free daily briefing at hundredweight.com. It's delivered right to your inbox every morning, 5-minute read. And if you've ever wished you could keep complete cattle records without the clipboard, the Cattle Record Guide lets you enter records from the field with your gloves on. Just say, "Hey Siri, try it free for 14 days at hundredweight.com. Good morning and welcome back to Cattle Market Guys. It's Tuesday, July 7th, and we've got a lot of ground to cover today. Let's start with the snapshot. Looking at the numbers, 5 to 6 weight feeder steers, that's the 500 to 549 pound range, closed last week at $457.30 per hundredweight. That's actually down slightly from $457.67 the week before, but still well above where we were back in early June at $446.56.
So we're basically flat at a real high level. I'll take it.
Exactly, and that's the story across the board. The heavier 6 to 649 weight steers came in at $415.87, down from $418.90 the prior week. Volume was interesting too. Light volume on those lighter steers at just under 1,238 head, but heavy volume the week before at over 5,000 head. According to the data, the national predictions have that 649 weight class holding around $407.20 this week, with a slight bump to $410.86 in 2 weeks before easing back down.
Sounds like the market can't decide if it's coming or going.
That's fair, and part of that indecision is showing up in the futures. The article from the cattle site on July 4th noted live cattle futures actually closed lower heading into the holiday, driven by weaker boxed beef values and softening cash trade. Then just today, we're seeing futures mixed as corn prices surge, which is adding fresh feed cost worries into the mix. Packer losses have deepened too. They're reportedly losing about $295 per head right now, which tells you there's real pressure building on the processing side.
Well, when the packer's bleeding that bad, somebody's going to feel it eventually, and it usually ain't the packer that keeps bleeding forever.
That's a good way to put it. Yeah, we'll dig into exactly what that futures volatility means for producers in our next segment, because there's a lot more to unpack there. But first, let's talk auction receipts. According to Beef Magazine, feeder and stocker receipts averaged 250,858 head over the first 24 weeks of this year. That's actually a hair above the same period last year, which had 250,129 head.
Steady as she goes, I reckon.
Steady is the right word. All right, let's move into our first deep dive, the futures market volatility we just touched on. Looking at the numbers more closely, that July 4th article really lays out a rough picture heading into the holiday. Live cattle futures fell as boxed beef values softened and cash trade weakened simultaneously. And that's not a great combination because it means demand signals were softening on two fronts at once.
Now that's a familiar tune.
It sure is. And then today's article adds another layer because now we've got corn futures surging, which raises feed cost concerns for anyone finishing cattle. When you combine softer cash trade with rising feed costs, that squeezes the margin from both directions. Revenues under pressure and input costs are climbing. That's exactly the kind of environment where hedging decisions become critical, but also where hedging can bite you if you're not managing your cash position carefully. Jim, you've lived through a stretch like this before, haven't you?
Brock, that reminds me of something. I remember back in '96 when corn shot up over $5 a bushel on that tight old crop supply, and cattle futures just went haywire trying to figure out what feeders could afford to pay. We had neighbors who'd hedged their calves in the spring thinking they had it locked in, and then the futures market started bouncing 50-75 cents a day. My banker about had a heart attack looking at the margin calls on some of these operations. I didn't have much hedge that year, just wrote it out, but I remember thinking the market was more scared of that corn crop than anything the packers were doing.
That's a pretty striking parallel to what we're seeing right now, Jim. Feeder margins get squeezed fast when corn spikes unexpectedly, and the futures market tends to overreact before it settles into a new equilibrium.
And that's the thing about it. Back then, prices dropped sharp as feedlots pulled back their bids just to cover the higher feed costs. Some outfits that were over-hedged without matching cash positions took real losses on those margin calls before things settled out by fall.
Which brings up an important point for anyone listening who's considering hedging right now. The lesson from that period still holds. Your hedge is only as good as your ability to cover the margin calls it might trigger, With packer losses already at $295 per head and feed costs climbing, producers need to think carefully about liquidity, not just price protection. It's not enough to lock in a favorable price if you can't weather the short-term swings getting there.
That's about as useful as a hedge with no fence posts. Looks good on paper till the wind blows.
Well said. Let's shift gears now to our second deep dive, global beef trade and what's happening with Brazil. This is a big one. According to the data, Brazil raised its full-year trade surplus forecast to $90 billion. That's up about 25% from their prior projection. And beef exports are a massive driver of that, up 38.5% in the first half of this year alone.
90 billion, that's a number I can't even picture in cattle terms.
It's staggering, and here's the specific breakdown. Brazilian beef exports hit a record 1.705 million metric tons in the first half of this year, with export revenue jumping 36% to $9.85 billion. China and the U.S. are identified as the leading demand drivers behind that surge. So while we're dealing with tighter domestic supply here, Brazil is absolutely capitalizing on global demand, and a good chunk of that demand is coming right from our own market.
Well, that's a horse race we might be losing a few lengths on.
It's competitive, no doubt, and there's more complexity brewing. Brazil's agriculture ministry is tightening meat inspection procedures right now, specifically targeting antimicrobial rules ahead of a September deadline because they're trying to avoid an EU import ban. So they're playing defense on one front while playing offense on trade volume on another. Meanwhile, there's a political wrinkle here at home too. Brazilian Senator Flavio Bolsonaro is seeking a 180-day suspension of a proposed 25% U.S. tariff, and that request is tied directly to the timing of Brazil's October election.
Politics and cattle prices, they've been dancing together since before I had my first pickup truck.
That's the truth. And it's not just Brazil pushing on trade policy either. A ranch group here in the U.S. is applauding new legislation that would reform tariffs and quotas, specifically establishing tariff rate quotas for import-sensitive agricultural products, and that includes lamb, live cattle, and beef. So there's a real push happening domestically to get more structure around how these imports are managed. On top of all that, there's a credibility issue brewing. USDA reported a surprising spike in national beef export figures, but the agency attributed those inflated numbers to delayed reports coming in from Chile and Italy.
So even the government ain't sure what the government's numbers mean. That's comforting.
It raises real concerns, especially when we're already dealing with tight domestic beef supplies. Producers need accurate trade data to make informed decisions, and when there's uncertainty about whether export numbers are inflated by reporting delays, that adds another layer of noise to an already complicated picture. The bottom line for producers watching this is that global beef trade dynamics are shifting fast, and Brazil's aggressive export growth combined with pending tariff decisions could have real implications for U.S. cattle prices in the months ahead.
Well, I reckon we'll just have to keep watching, same as we always do.
Fair enough. Let's move into our final deep dive for today, supply and production trends here at home. This ties directly into everything we've discussed so far. According to the data, total beef production is now projected down 4.5% to 5% compared to last year, and there's an expectation of further decline next year to the lowest levels we've seen in recent history.
Now that's a number that ought to get everybody's attention.
It should, and here's what's interesting. Cattle on feed numbers are actually reported as up, even despite these falling production forecasts. That seems contradictory on the surface, but it reflects the complexity of the supply chain right now. Meanwhile, feeder and stocker cattle marketings for the week ending June 20th came in 4.4% larger than the 3-year average. So we're seeing solid movement through the system, even as the broader herd size continues shrinking. Jim, does this remind you of anything from years back?
It sure does. Back in '96, we'd been through a few rough years of drought and high feed costs, and a lot of outfits around here had culled their herds down hard just to survive. By the time '96 rolled around, everybody was talking about how there just weren't enough cattle left to fill the feedlots the way there used to be. I recall going to a sale in Amarillo and seeing half the pens empty that used to be packed solid on a Tuesday. Production numbers started dropping that year, and everybody knew tighter supplies were coming, but it took a while for prices to catch up to that reality.
And that's exactly the pattern we might be watching unfold again right now, Jim. The lesson from that period is worth repeating. A shrinking herd doesn't show up in your price the day the numbers get reported. It shows up months later when the calves that weren't born finally aren't there to sell. We're seeing early signs of that same dynamic, tighter production forecast today that likely won't fully show up in cash prices for a while yet.
And by the time it does show up, everybody acts surprised, like they didn't see it coming.
That's often how these cycles play out. One more data point worth mentioning. The May USDA cold storage report showed beef in freezers down slightly month over month and down 1% year over year. So there's less of a cushion sitting in cold storage to soften any supply tightening, which reinforces this whole tight supply narrative we've been discussing.
Less in the freezer means less room to hide from a shortage.
Exactly right. So as we wrap up today's episode, the through line across all three deep dives is pretty clear. We've got futures volatility driven by feed costs. We've got international competition intensifying from Brazil. And we've got a domestic supply picture that's tightening in ways that likely won't show up in cash prices immediately. Producers need to be watching all three of these threads together, not in isolation.
Well, if there's one thing 40 years in this business has taught me, it's that the cattle market never gives you a straight answer, but it always gives you a story.
That's a great way to close it out. Thanks for joining us on this Tuesday market update. We'll be back with more analysis as these stories develop.
Y'all take care now and watch them margin calls.
That's all for today. Remember to sign up for our free daily briefing at hundredweight.com. And if you want complete cattle records without the hassle, try the Cattle Record Guide free for 14 days. Enter records from the field with your gloves on. Just say, "Hey Siri."
Catch you in a couple days.
All right, see you then.